Somewhere off the coast of Iran, a tanker slows down. Somewhere in Mississauga, your mortgage renewal just got more expensive. Nobody asked either one of them. The Bank of Canada has cut rates for a year straight. It just held again. And your fixed mortgage rate hasn't moved with it. That's because the Bank of Canada doesn't actually set your fixed rate. Something else does. And for the last few months, that something else has been a war. Here's the mechanism, in order. Fixed rates don't track the Bank of Canada's policy rate. They track Government of Canada 5-year bond yields. Bond yields move on where investors think inflation is heading. And nothing moves inflation expectations faster than the price of oil. Which is why a shipping lane most Canadians couldn't find on a map has been quietly setting your mortgage quote. It's called the Strait of Hormuz. About 1 in 5 barrels of oil on Earth moves through it. When that lane gets threatened, oil doesn't drift, it spikes. And bond yields move before your bank's rate sheet even updates. In March, it did more than spike. Conflict in the region brought shipping through the Strait of Hormuz to a near standstill, a route that normally carries a fifth of the world's oil. Crude oil jumped more than 50% in a single month, the largest monthly oil shock on record. That single event pushed Canadian inflation expectations up and dragged 5-year bond yields with it, which is the part that actually lands on your renewal letter. Your fixed mortgage rate is priced off that same bond yield, most weeks with only a small spread on top. Gas at the pump is the version of this story you can see. Your mortgage rate is the version nobody points a camera at, which is why something unusual is sitting in the market right now. Normally, variable rates sit at or above fixed. Today, the best 5-year variable is running around 3.25%. The best 5-year fixed is just under 4%. Variable is cheaper. That's backwards from how this market usually behaves, and the oil shock is a big part of why. On a $500,000 balance, that spread is worth about $200 a month. Choose wrong, and it adds up to $12,000 over 5 years. Your fixed rate is now also a bet on foreign policy. That part doesn't show up anywhere on the rate sheet. Quick thing, if this is actually making sense so far, hit like. It tells YouTube to show it to more people who'd find it useful too. The Bank of Canada sets the overnight rate. That drives prime, which drives variable, and the bank has been cutting. Bond markets set the fixed side, and bond markets are still pricing in the chance this doesn't stay calm. 2 different systems, moving on 2 different clocks. Here's why this still matters this week, not just in March. A ceasefire in the region briefly held through the spring, and oil eased off its peak. Then, in late July, the ceasefire broke down. Fighting resumed. Crude jumped again within days, over 4%, back above $70 a barrel. Markets had started pricing in calm. That reversed in under a week. That's exactly the kind of headline that keeps bond yields from following inflation lower. Even while the domestic numbers actually look good, June's inflation reading came in at 2.8%, down from 3.2%. Core inflation, the measure the bank steers by, sits at 1.9%, already below target. Domestically, the case for lower rates is real. The oil risk sitting on top of it is the reason your fixed quote hasn't felt it yet. So if you're weighing fixed against variable right now, understand what you're actually choosing between. Variable is a bet on the bank's domestic path, and that path has been pointing down. Fixed costs more today partly because it's still carrying an insurance premium against a conflict most people stopped reading about. That doesn't make one automatically right. It makes this year's version of that decision unusually hard to call with the normal rules of thumb, which is exactly why it deserves its own real math, on a real balance, rather than a guess. That's next video. Until then, here's what to track. 1. Watch oil, not just Bank of Canada headlines. Crude moves show up in bond yields, and your fixed rate quote, days before your bank updates its sheet. 2. Don't lock a rate the same day a ceasefire is announced. One good headline doesn't undo a bond market's pricing. Wait to see if it holds for weeks, not hours. 3. An energy shock can override a good inflation print. The bank's next decision is September 2nd, reading July and August data. If oil stays elevated into that meeting, don't expect a cut just because domestic inflation looks fine. The bank has already shown that this year. 4. Get a rate hold now, It's free protection. If you're within 4 to 6 months of a renewal, get a rate hold regardless of what oil does next. Most lenders hold for around 120 days at no cost. 5. Fixed isn't automatically safe. It's a risk premium. This year, fixed is the side of the market carrying a live geopolitical risk premium. Know what you're actually paying for. A war you may not be following moved your mortgage rate more than the Bank of Canada did this year. That's not a metaphor. That's the bond market, doing exactly what it always does, pricing risk from wherever it's actually coming from. If this helped, like it, drop a comment, and share it with someone renewing this year. Subscribe for the numbers behind your money, explained like this. Next, fixed versus variable. Real math on a real balance, because now you know why that call is harder than usual in 2026.